Hey everybody, Kevin Shortle here with part two of our last video series for the Real Estate Without Renters podcast. Once again, we're going to pick up right where we left off. Very interesting information going back from 2018, how it correlates to what is happening today. And then, of course, at the end, we're going to talk about what new opportunities it's going to create and how you can navigate through that minefield, if you will. So stay tuned and enjoy part two. Here's a quote that was also in there. The extremely high share of non-bank lenders in FHA and VA lending suggests that non-bank failures could be quite costly to the government. But this issue has received very little attention in the housing reform debate. How about that statement back in 2018? Is that coming to fruition today or what?
My gosh. And I was looking at your prior slide, you were showing the increase from 08 to 16. And then here we are in 22 and the drop from 700 to 273. History repeats itself. It is what.
Yep, it sure does. Here's another one for you. So many people, most people, I think, in this industry and people listening to this podcast and watch it on YouTube are familiar with Fannie Mae and Freddie Mac, right? They're the secondary mortgage industry for the banking system, right? Fannie Mae, Federal National Mortgage Association, and Freddie Mac, the Federal Home Loan Guarantee Corporation, something like that. These two big entities were privatized. We had to bail them out, so they're more government-owned these days, but semi-privatized, quasi-government companies, as they're known. The other one is Ginnie Mae. And Ginnie Mae is different than Fannie and Freddie because Ginnie Mae is 100% owned by the government. So it's completely set up with the government. It was never privatized, and they're not going that direction. So taxpayers are directly 100% backing Ginnie Mae, where there's less of a degree of that, although still high, with Fannie and Freddie. But when you look at the ones, the GSEs, which is Fannie Mae and Freddie Mac, the government specialty enterprises was that GSE, government-sponsored enterprises, Fannie Mae, Freddie Mac. You can see that that line going back in 2001's, the loans 20%, 25% were sold to them, and then it dipped a little, and up in 2016, it's right about 50% of loans being sold to them. More loans being sold, so it's a percentage there. The Ginnie Mae is the leader now. It's way up there towards 75% of the loans of these non-banks being sold to Ginnie Mae. So that's directly to the government here. The rest have some backing within that. There's your lines crossing with banks and non-banks, which we've really already talked about here. But GSEs and Ginnie Mae guarantee mortgage-backed securities. There's a number of differences. So here's the thing. Banks are protected much better than non-banks. Non-banks with certain loans are still allowed to get backing by GSEs, Freddie and Fannie, and also Ginnie Mae. But here's the differences. Ginnie Mae servicers are exposed to greater liquidity strains and a greater risk of absorbing credit loss. So the solution was, okay, non-banks, you can do these loans, we'll back them, but if things go wrong, you're on the hook for a lot more. And that includes the servicing company, that includes any kind of credit loss. So they're directly going to suffer a loss. And that's what's leading up to what's happening today. So again, this is in a report back in 2018, and you can see through the frailty of the system and other events that have happened, this is now being called due here. Nice little chart here showing you who absorbs the loss when a loan goes bad. So as these loan defaults go up, how they are structured in the background, who owns them, who services them, and who's responsible for the debt is a little bit different here. So on the one hand, the ones that go through the GSEs, you've got the first thing when loans go bad is homeowners' equity starts to get eaten away, right? Because they start to build up an arrearage account of payments that they owe and those sorts of things. Typically, the house goes into disrepair, et cetera. So the first person to suffer the loss is homeowner equity, especially if it goes into the foreclosure. Think of a home going into foreclosure. Who takes the first loss? Well, the homeowner does on that. Then there's typically private mortgage insurance, and they would take their loss. If it goes past that, then it goes directly to Fannie Mae and Freddie Mac. They absorb that loss, and typically they will be bailed out by the taxpayers and the government. And we saw that back in 2008. The ones operating under Ginnie Mae, which again has seen the greatest increase of these non-banks, homeowner equity is first. Then if there's FHA insurance or VA guarantee, that is next. Then it goes to the capital issuer, which is the non-bank entity and the servicing company. They're directly on the next level of loss priority. So they have to absorb those losses, and then it falls to Ginnie Mae. So that's where the dominoes start to fall here with this warehouse lines of credit. So the system here, David, on how these work is pretty straightforward. They're essentially doing a technique in the industry on a smaller scale, individual investors who do hypothecation, right? They basically put their loan up for a line of credit, right? That's essentially what these non-bank lenders are doing, right?
Well, it's the repo lines. It's like we were talking about, I think it was 2 months ago. And this was the first break in 08. And if that happened 2-3 months ago here, where over the weekend, the private lenders go to the warehouse to get reimbursed, or to Ginnie Mae, and nobody buy the loans.
Yeah.
And then the Fed stepped in. Okay, so another bailout. But my point is, there was a break there in the system. That's a precursor. That was probably the canary in the coal mine of what's coming down the road.
Mm-hmm. Yeah. So here's what happens in a nutshell. You've got a mortgage borrower. Somebody wants to borrow money to buy a property. They go to a non-bank originator. That's what most people qualify for. And once again, more non-banks are doing loans than banks. So what they have to do to get the loan is the borrower has to promise to pay it back. And they do that through a note and through a mortgage. So the mortgage borrower gives the promissory note and the security agreement known as the mortgage to the non-bank originator. The non-bank originator then pays money to the seller on their behalf. Very simple. That's how an everyday transaction works. In fact, that's how it works with a bank as well. But behind the scenes, which most people don't realize, is, well, where did that non-bank originator get the money? Well, they get it from a warehouse lender, which is typically a bank. Now, it can be another investment company, et cetera, but many times it's a regular bank that is doing this warehouse line of credit. So the deal typically today, if you look at the books, which I have looked at, lenders' funds are only in 5% of the total company. The rest of it is borrowed. So imagine that. They only have 5% of their money in the deal. 95% of the money that the non-bank originator gets is from a warehouse lender who's giving them a line of credit. So how do they get that line of credit? They pledge, hypothecate the loan, the note and the mortgage to the warehouse lender in exchange for money. That's how it works. Okay. How great is that if you can do loans like this with only putting 5% of your own money in, right? Just borrow 95% of the money. And that model, obviously it works. It works on a very, very high level. Once again, going back to that article, just the two banks that had a line of credit with First Guarantee, what was that, $400 some odd million, right? And that's what they could lend out just with those two lines of credit. But we saw they did $10 billion in loans the year before, 95% of which was borrowed. Man, in good times, you can make a lot of money putting very little of your own money into these deals when you have an arrangement like that. But it goes further. Okay. And this is why that Bloomberg article is so significant here. If we look at post-origination, okay, so if we say, all right, the loan's already been originated, let's see in the background how this whole thing is set up before they can do a loan. The warehouse lender is giving money to a non-bank originator. The non-bank originator then is going to the special purpose entity, which is Fannie Mae, Freddie Mac, or Ginnie Mae. They go to them and sell that loan. So when that loan is sold, the money from that sale, Fannie Mae, Freddie Mac, and Ginnie Mae pays to the warehouse lender because that's the one who did the money on the loan. So the warehouse lenders in this circle, if you will, of they're giving the mortgages or selling the mortgages essentially to the government in exchange for money. Okay. And that money they're giving to the non-bank originator who's lending it to the consumer. So you have this big cycle here that is a well-oiled machine until things go wrong. And when things go wrong, like all the things we talked about, inflation, cost, raising the cost of loans, but take it to another level, David. I get you got consumers who are facing inflation, right?
There's nobody to bail them out. I mean, whether it be the gas, the food, whatever, they got to go to work. They live in the outlying area, and then they got to come in town. How's it all going to work? It doesn't. I have a lady in Michigan. She's in the medical field. She lives in Detroit. She's behind a year. So she really wants to keep her house, but she's working now in Toledo to cover her nut because inflation was eating her lunch.
Yep.
She's a credible individual. So we're not going to get bailed out by the bank. Kevin, I have a question for you. Would you ever, in normal circumstances, buy a loan at 95% loan to value?
Oh, no, your risk is way too high.
Okay, so we're not going to get bailed out. Again, I'm trying to take it positive. What's a safe action? So as a lender, as a note investor, you've always got to keep that cushion behind you to protect your backside.
Yep.
Because there's no way to bail you out.
Right. We don't want to create crazy loans like this, nor do we want, to your point, to buy loans like this where we're in it for 95% of what the property is worth, even by extension there. And that's, especially if you're using borrowed money. So they're borrowing money, they're borrowing 95% of the money, and then they're lending 95% of what the loan on 95% of what the property is worth, because people only have to put 5 or 3% down. That's crazy. Property values don't have to drop that far before there's zero equity in the property. They don't have to go much further before you're upside down.
It's worse than Bernie Madoff.
Yeah, it's this whole lending cycle. They're basically creating promissory notes and cashing and exchanging cash. That's what this whole cycle does. And it works well when the consumer, the borrower, can make the payments. When they can't make the payments, that's the cog in this wheel of this machine. And that's what immediately raises the vulnerability. So the vulnerability in these warehouse funding type of arrangements for these huge non-banks, again, doing tens of billions of dollars worth of business, how could they crash that quickly? Last year, 10.6 billion, this year bankrupt. Yes, it can happen that quick because the dominoes fall when the consumer stops making the payments. That's when the oil in the machine just dries up. Okay. So what are the vulnerabilities? And again, in this report from 2018 outlined very clearly, here's the vulnerabilities with this arrangement. Number one, pipeline aging. I'll explain what that is. Rollover risk is number 2. And number 3, covenant violations, promises that they've made in writing that they have violated. Those are your 3 big vulnerabilities. Pipeline aging. What the heck are they talking about there? All these are you considered. What's your pipeline? When you're in mortgage lending business, what's in our pipeline? What are the loans coming down the road? And what happens with pipeline aging is these warehouse funders, they can start to look at, well, you're not performing as good as you did here, so we're going to do a margin call. We're going to charge you additional interest because you're not living up to the expectations when we made the loan. Of course, that's all agreed upon to get a warehouse line of credit. They can add penalties in there. Okay, so they're at risk at any time in not meeting the original criteria. That's one of the things I'm absolutely certain, without even seeing any paperwork, that happened at First Guarantee. But that wasn't the only thing, because these are all related. Rollover risk is this: these lines expire. Maybe you have a 5-year warehouse line of credit that gets renewed every 5 years. That renewal could be at a higher cost. And why wouldn't it? A warehouse lender has to make margin as well. So if inflation has gone up, their margins or real margins have gone down, of course there's going to be a higher a line of credit, a higher cost to that line of credit, or they'll just expire it and say it's not worth it for us to do this because inflation's eating us alive over here. We're not making anything. So if the warehouse line of credit is now gone and they pull that credit, that spells remarkable trouble very, very quickly. Remember what that attorney who's working with the bankruptcy and first guarantee said. He goes, these warehouse lenders are on top of it right now, and they are pulling that line of credit very quickly. And you better believe if you are a lender that has a warehouse line of credit that you're lending out, and let's say a company, a non-bank lender has 5 different warehouse lines of credit, and one of those 5 pulls that line of credit away, they did it for a reason, and there's some risk exposure there. And believe me, those other 4, if they don't know about it, they're going to know about it soon enough, and they're going to pull those lines of credit. Now all of a sudden they have no capital to work with. That's a big vulnerability, and that's why you have a company that did 10.6 billion in one year and bankrupt the next. Crazy, right, Dave?
Yeah, and Kevin, we are one black swan event away from any of this happening.
Mm-hmm.
When's the black swan event going to happen? I don't know. Today, tomorrow, next week. Where are you as an investor? How are you protecting your backside? Keep going back.
Because it doesn't take much when you're operating on these margins for the third vulnerability here, which is covenant violations. If they don't keep and maintain the ratios of liabilities, unrestricted cash on hand, if they don't keep a profitability, if they don't keep the level of net worth on that company up to the standards of the warehouse funding arrangement, it gets pulled, it gets changed, it gets modified, and then boom, they are out of the business. And that's the vulnerability. Now, I'm not going to go over all these slides here, but I've got a couple more slides. If you're watching this on YouTube, you can see I'm not going to spend much time on it. So for those who are just listening to this, there's a high degree of volatility in these loans. Going back again, these are numbers, and it's right on the slide here, going back to 2017, and then in this report at 2018. And one of the things that your eyes immediately as an investor zoom into is a point that David was making earlier on these non-bank Ginnie Mae loans, the ones that are backed by the federal government. They are doing a medium loan to value percentage of 96.5%. People are putting 3.5% down on average is what that means. That's a recipe for disaster when property values take a tick down. Over the years, as property values have been going up, hey, great, that's what we did the loan at, 96.5. Now we're only in it for 70 or 80. But what happens if things start to go down there? So they're doing some high level loan to value, even the ones that go through the GSEs, which again have less risk. And that's why we see more of these backed by Ginnie Mae, because they can do more loans, lending at 96.5% of what the property is worth than what the GSE level is at 80%. So these ratios, whether you're an individual investor or whether you are a big company, you got to pay attention to these ratios because you'll make money in the heyday. And Dave, we've seen this on a smaller scale of investors who were just crushing it because they're doing these type of ratios on their loans, and then you don't hear from them, all so they're gone. It's like, well, what happened to that little business that was just cranking out these loans? They're not there because they didn't identify what their potential risks were. Agreed?
Agreed. I mean, you can only win so many times in Vegas. The odds will catch up with you. So are you going to keep betting on the come?
Yeah.
Or are you going to take care of it? Because you could be flying up here and the rug gets pulled off from under you, then you're down here, and the guy that was supposedly the turtle is way up here. Where do you want to be?
Yeah. Turtle wins the race, as they say. So how does this reflect? We went to a big topic here, a long topic, an important topic, but let's pull it back and talk to the individual investors, because we probably have some people, thinking now like, well, gee, what's my exposure? Maybe I own some notes here. What kind of exposure do I have? And I'll start first is with my personal consulting practice, my mentorship program. I don't think and I talk with them on people on a pretty regular basis. I don't think I have anybody that's in a position where a 20% drop in property values would affect them at all.
Right.
And the reason is, as you know, we talk about risk first. And when we're buying a note, one of those important ratios to limit your risk is the investment to value ratio. And I always tell people you have to monitor that first. Don't just look at reward. Don't look at, for example, everybody, if, you know, I had somebody in the past, I'll use simple numbers, $100,000 property, and they created a somebody created a $95,000 loan on that property, but they did it at 12% interest. And I had somebody come to me and said, man, I think I found a great deal here. I can buy this loan at a 12% yield. So if you run the numbers, he was paying like $93,000, $94,000 for this $95,000 loan, thinking it was a good deal because his yield, his return would be 12%. And I'm like, no. What are you doing if you get that loan and you have to foreclose? You basically are in a $100,000 property for $94,000. Too many things can go wrong. That is not a good deal. I said, the first thing I got to look at is what is the most I want to be in this in case things go wrong and I have to take that collateral back.
Right. When we were buying loans off of spreadsheets, Kevin, back in the day,
yeah,
the first thing I do is run LT, loan to value, investment to value, and yield. And then I'd separate them out. So if they had a high LTV and the yield was higher, I got rid of it because I wanted the safety. So then I'd go through and filter them out. Where's my yield? Based upon a safety factor.
Mm-hmm.
And if I'm there, I'd buy them. So I would not buy a pool of 30 notes. I would only cherry pick the ones that worked. And there's 2 or 3 that I've got right now, and I wish it wouldn't have bought them, but I'm still safe.
Right.
Because the numbers were there. You got to work through them and causes issues, mental, like I got to do this junk. But it's like, no, you're good. Just work through it. It's all fine.
Yeah. And I've seen enough of your deals over the years where you've had to take some things back. They went a different turn, twists and turns, and you just got to noodle your way, navigate your way through it. And you end up being fine with them because the safety is there. If the safety mechanism is not there, then you have to go like, well, is it worth it for me to keep throwing more money at this thing where the property value is not worth it? That's where you get into trouble. And the investors that I've seen that got too aggressive and just were looking at yield, they're not around anymore. And that was some mid-level companies and certainly some individuals. But now and today, these days, I work one-on-one with people. So I always point out that, hey, let's. You can marginalize certain numbers, but you can't go crazy. You got to look at the individual deals. So, the assumption's always that. And then risk, we can get creative. We can buy partials, make an offer to do a partial with a buyback. You've done those with an option. You can do hey, I'll buy half of your note now and I'll buy the other half, multi-stage buyout later on as your risk starts to change. And that's where the creativity and the advanced techniques come in. So no matter what gets thrown at us in all of this, because we can't conclude that the things are going to come crashing down, that we're starting just to see some companies go out of business. These were the ones that were taking the most risk. Maybe things level off, but we have to be aware of it. But the creativity, I think, is really where the bulk of the solutions come in, right? Sticking with your numbers and then being creative on the buying side, the workout side, and everything else, right?
Right. And we talked about this, but who's the guy who wrote The Big Short? Michael, whatever, I can't remember his name.
Yeah.
But he said right now we're watching a plane slowly going down, getting ready to crash. Right? Okay. So to your point, now I'll end it with this. I have a couple of notes from a guy out in the middle of the Pacific.
Right.
And now he's dying of cancer. That's why he's selling those notes. Okay. But I sold those notes to him, partials with a 5-year buyback. That's just right now. I've got so much back end equity. He's going to come out good. I'm going to come out good. I'm going to resell them. It's all good. Safety, safety. And I'm still smiling all the way to the bank.
Yeah. Yeah. It's really a combination, everybody, of 3 main ratios and numbers here. You look at your investment to value, which is your overall risk. How much are you into this? What are you investing versus what your collateral is worth? That's really all we're looking at there. The second one is going to be your investment to unpaid balance. And that one, that varies so much, whether it's performing, non-performing note. And the third one is your yield. You have to meet a certain yield expectation or you pass on it for that as well. So in other words, if your risk is low, but your yield's still not high enough, you're making a 5% yield on something very, very safe. Well, that's not exciting. That's not what a note investor would look at because there's too much inventory to look at. So it's really those ratios and numbers that you start to measure out. And as you said in your spreadsheet, you would just do like I would do, just create a row. Boom, what's my ITV? What's my yield? What's my investment to UPB? And then I would just play with those numbers, the ITV and the yield being the most important of the three, and just play with those numbers and say, where am I on this thing?
And I'll interject this too, Kev. I buy assets assuming they could very well go bad. So I look at the political environment in these different states. So this is Dave Franicki speaking now. Mm-hmm. So I don't want to offend anybody, but anything Maryland, New Jersey, North, I'm not there. Mm-hmm. I don't go to Pennsylvania, and I eliminate a couple of other states just because. What worst case scenario? I don't want to fight that gorilla. I can't beat it.
Yeah. Well, for example, I had warned my clients about New Jersey. New Jersey was taking over 4 years to foreclose.
Well, our friend in
that's changed, by the way. Now, everybody, it's down to 2 again, but still 4 years.
Yeah, he had a note that went 5 or 6 years, and then a couple of years ago, I was speaking to an attorney. He had just finished up a foreclosure in New York City, 10 years.
Jeez.
As an investor, as a capitalist, it doesn't work. Yeah. Too much brain cells are lost.
Yeah. And landlords who are listening to this, you understand because of eviction laws. Sometimes it's like, who's the law favoring here? I'm the property owners. I get it. But so to your point, we look at that. And by the way, for those of you who are real estate investors, one of the most popular models out there right now is buy real estate at a discount and sell it with financing. Create a note and then keep that note for a while, either sell all of it or part of it down the road, which means you're going to be creating paper. And if you're creating paper, same thing. Keep in mind what you're creating with the saleability of that down the line. Whether you plan on selling it or not, your life can change. Always go under the assumption that I want to create a good quality, marketable note that I won't have to sell at a huge discount down the line. Gosh, have I seen people make a mistake on that before.
So Kevin, everything that we're talking about is marketing and negotiation. So therefore, how do you get the product? How do you get the real estate? How do you get the note? How are you going to get there? And I think that might be something we might want to talk about down the road. There are ways to buy notes using technology, to buy houses using technology, using your skill sets then to take it to the direction that you want to go. You mentioned landlords. That's a very strong topic for down the road.
Yep. Actually, instead of down the road, let's make that our next one. So our next one, everybody, we're going to talk just about that. How do we buy real estate and essentially convert it to paper? What I mean by that is you buy the real estate, you sell the real estate. Now you own the paper, not the real estate. That paper is an asset, obviously, that you can sell in full or in part. And it's pretty crazy how some of the technology has changed the way that you can do this. When you add creativity with technology, man, there's some awesome opportunities. So in all this negativity, remember, everybody, these are opportunities that are being created. You just got to get your knowledge level up there. So David's very knowledgeable on that. Visit David. What's your website again? Everybody can go to
Capstone Capital USA.
Capstone Capital USA. Check out Dave's website there. And of course, mine is realestatewithoutrenters.com or kevinshortell.com. And I do personal mentoring in the business. The only one who does it with the experience that I have. And at the results that you'll get with that are really, really outstanding. So thanks as always, Dave, for being on with me in this special series. And thank you, everybody. And please share with a friend as well. Talk to you again soon.
Okay.